Hey everyone, welcome back to The Explainer. Today, we are popping the hood on a seriously fascinating mid-cap industrial player, Elecon Engineering. If you've been looking for a data-driven, totally no-fluff look at a company's business model, their fundamental financial health, and valuation, you are absolutely in the right place. We're going to look closely at their growth runway, see exactly how they allocate their capital, and analyze what the numbers are really telling us about their future.
All right, let's dive right into this. Here's our roadmap for today. We're going to cover the business of Elecon, their financial health, management's plans for future growth, ESG and risk factors, and we'll wrap it up with valuation and the analyst verdict. So, Part 1. The business of Elecon, engineering at scale. Over the last few decades, Elecon has totally transformed. They went from a domestic manufacturer straight into a global leader in specialized critical engineering equipment. Just look at this massive precision-engineered industrial gearbox. Elecon is an absolute market leader for these critical components, and their addressable market, it's huge, because this equipment is literally the mechanical backbone of heavy industries. We're talking power transmission systems from massive steel and cement plants, right up to India's indigenous aircraft carrier, the INS Vikrant. Basically, when standard off-the-shelf solutions fail, these are the guys the industry calls.
So, where is the actual money coming from? Well, their industrial gear division is the primary engine here. It pulls in a massive 78% of total revenue. It's highly efficient and a major high-margin growth driver. The other 22% comes from their material handling equipment, or MHE, division. And what's really crucial to understand about this MHE side is that they recently executed a major, and I mean major, strategic pivot. They completely ditched their low-margin legacy EPC contracts to focus purely on product sales. And guess what? It worked. They successfully turned this division into a highly profitable contributor.
Now, you don't become a leader in heavy engineering by just building generic parts, right? Elecon's economic moat is built on a rock-solid foundation, a team of over 105 dedicated R&D engineers. They've got 4 patents granted, 3 more pending, and they specialize in complex, custom, and reverse engineering. But honestly, the real defense mechanism here is that last point: massive diversification across over 35 different end-user industries. This is a game changer because it protects them immensely. If the cement sector has a terrible year, no problem. The defense or marine sectors can easily balance it out. It really shelters them from those nasty cyclical downturns.
Moving on to Section 2, Financial Health and Metrics, the numbers game.
Let's walk through the numbers. Elecon is currently sitting at a market capitalization hovering somewhere between 11,800 and 13,000 crores. Looking at valuation, their price-to-earnings ratio is at 34.66, and the EV to EBITDA multiple is 22.2. Now, I know what you might be thinking. On the surface, that PE might suggest the stock is slightly expensive compared to historical averages. But hold on, look at that final line. Their return on capital employed, or ROCE, has consistently stayed above 25% for the last 3 years. That is huge. It tells us management is deploying their capital with incredible efficiency, and honestly, the market often demands a premium for that kind of return.
And that efficiency leads us to one of the biggest green flags you could ever hope to find on a balance sheet. Negative 425.28 crores in net debt as of March 2026. In the incredibly capital-intensive world of heavy engineering, being entirely debt-free is super rare. So what does this actually mean for us as observers? It means Elecon is sitting on a massive cash war chest. They're generating incredibly strong free cash flows, which lets them fund operations, pour money into R&D, and expand capacity entirely internally. They don't have to borrow a single dime from the banks.
Looking at their growth trajectory over the last 3 years, it's really a story of serious resilience. In FY25, they had this massive 14.9% jump in revenue, hitting 2,227 crores, with a profit after tax of 415 crores. Now fast forward to FY26, and yeah, things slowed down just a bit. But context is everything here. They were facing severe external geopolitical headwinds, the Red Sea crisis, delayed customer orders, the whole shebang. But even in that incredibly tough environment, they still delivered 6.2% revenue growth, hitting 2,366 crores, with 341 crores in profit. That right there is a true testament to the stability of their order book.
All right, Section 3, Management and Future Growth, Building the Future.
This timeline perfectly captures management's exceptional execution discipline. Back in FY24, they made the really tough call to exit those legacy EPC projects we talked about earlier. They prioritized long-term profitability over, just chasing short-term, empty scale. Then, by FY25, they were aggressively expanding their OEM, or original equipment manufacturer business, over in Europe. And right now, in FY26, they're rolling out a 400-crore capital expenditure plan and leaning heavily into the defense sector. All of this is building toward one massive, highly ambitious goal. By FY30, they want 50% of their total revenue to come from overseas markets.
So how exactly are they paying for all this? Well, through some really impeccable capital allocation. There's absolutely no frequent or emergency fundraising going on here. That 400 crore capex, funded purely through their own internal cash generation. Now, transparency is super important to note here. Management had set a target for a 24% EBIT margin for FY26, and they did miss it slightly, coming in at 22.1%. But they've been incredibly upfront about the supply chain disruptions that caused the miss, and that transparent communication goes a long way in maintaining strong investor trust. Plus, with exports currently sitting at around 23%, they are actively building a fantastic geographic hedge against any potential domestic slowdowns.
Next up, Section 4, ESG and risk factors, the broader context. When we weigh their corporate governance, we actually see a really interesting contrast. On one hand, they have these very ambitious science-based targets to reduce their absolute greenhouse gas emissions by over 54% by 2033, and they're already sourcing 20 to 30% of their energy from renewables, which is great. But on the other hand, we do have to acknowledge a few minor regulatory hiccups. There are some GST penalties of roughly 5.5 lakh rupees, which are currently under appeal, plus some brief weather-related delays in commissioning new solar and wind capacity. But honestly, when you weigh the two, those fines are almost negligible compared to their massive operational scale. It shows an overall very sound governance structure.
And finally, Section 5, Valuation and Analyst Verdict, the bottom line. Looking at the shareholding pattern, it reveals a very healthy mix. As of mid-2025, the promoters hold a commanding 59.28% of the company. The public and retail investors hold a really robust 27.28%, with foreign and domestic institutional investors taking up the rest. Oh, and Elecon recently confirmed that their strategic 16.62% stake in a related company, EIMO Elecon, remains entirely clean and unencumbered.
So, the absolutely crucial point here is this 0% figure. The promoters have absolutely zero pledged shares. Listen, when the people running the company aren't putting their own shares up as collateral for loans, it signals massive internal confidence in the company's financial stability and its ability to generate cash flow.
Which brings us to the analyst verdicts. With the current market price generally bouncing between 526 and 580 rupees, brokerage firms are definitely seeing some significant upside. Mangal Keshav maintains a buy rating with a target of 695 rupees and 52 paise. That represents about a 20% upside based on a 21 times target PE multiple. MNCL also maintains a buy rating, setting a target of 707 rupees, or a 31% upside, using a sum of the parts valuation. And both of these firms point to the exact same key catalysts: Elecon's undeniable sector leadership, their expanding addressable markets, and the strong expectation of large upcoming Navy orders, along with global OEM partnerships.
All right, I want to leave you with this final thought. Elecon Engineering has undeniably built a debt-free, high-margin, absolute powerhouse of an engineering firm. But as they scale from being a domestic champion into a truly global player, the real question becomes this: can this management team actually achieve that highly ambitious 50% export target by 2030, all while navigating the crazy, unpredictable uncertainties of global supply chains and geopolitical headwinds? Well, their execution track record certainly says yes, but the global market is going to be the ultimate test. Thank you so much for joining me on this explainer, and keep learning.